Most traders struggle, not because they lack strategies, but because they do not understand how price actually moves. Entries look good, yet the market often does the opposite. The problem is usually missing context, not poor execution. Hello and welcome back to another video here on the ComLucro channel. In this video, you are going to learn how professional traders read liquidity, market structure, and execution as one connected process. We will break down how price is delivered, where liquidity forms, and how to align higher time frame direction with precise intraday entries. By the end of this video, you will understand not just where to trade, but why price reacts where it does, and how to approach the market with clarity and intention. If you enjoy this kind of content, make sure to like the video, subscribe, and turn on notifications so you do not miss what comes next. And let us know in the comments what topics you want us to cover next. You will also find links to our trusted partners in the description. When you use those links, you help support the channel and keep this content moving forward. First, let's define and understand the concept of liquidity zones. These zones are specific areas on the price chart where there is a significant accumulation of buy or sell orders. These zones are created by large institutional players who seek to move the market in their favor by manipulating market sentiment. Correctly identifying these zones can offer a strategic advantage to traders, allowing them to predict price movements with greater accuracy. Within the concept of liquidity zones, there are two main types: internal liquidity and external liquidity. Internal liquidity, also known as fair value gaps, FVG, refers to areas within the current price structure. These gaps occur when there is a significant difference between the closing of one candle and the opening of the next, resulting in a liquidity void. These areas are important because large market players tend to fill these gaps, creating trading opportunities to capture movements back to fair value. External liquidity refers to zones outside the current price structure, usually found at previous swing highs and lows. These are the areas where many retail traders place their stop-loss orders. For instance, at a swing high, stop losses often sit just above the level, creating a pool of liquidity that large market participants may target before reversing price direction. In practice, price tends to move between buy-side and sell-side liquidity, seeking these clusters of orders to generate movement and volatility. Recognizing how liquidity flows between these zones helps traders anticipate where price might react and refine their entries, exits, and overall strategy. To understand this behavior more deeply, let's explore the psychology behind liquidity zones. When price enters an accumulation or distribution phase, it often forms equal highs and equal lows before beginning the next major move, the markup or markdown phase. In these phases, we see a support level at the bottom and a resistance level at the top. Retail traders typically look to buy when the price reaches the support level, placing their stop losses just below it. This creates a substantial liquidity pool beneath the support level, consisting of the stop losses of these buyers ready to be triggered by the market. Additionally, it includes sell stops from retail traders who plan to sell if the price breaks below the support level, believing that such a break will initiate the markdown phase. On the buy side, when we encounter a resistance level at the top of the equal highs, many retail traders look to sell as the price reaches this resistance, setting their stop losses above it. We also see buy stop orders from retail traders, expecting the price to continue rising if it breaks through the resistance. This scenario creates a well-defined liquidity pool with various types of orders ready to be swept by the market, both above the equal highs and below the equal lows. Therefore, we have buy-side liquidity at the top of the phase and sell-side liquidity at the bottom. In essence, these concepts represent the same idea but in opposite directions. Buy-side liquidity refers to areas in the chart where there is a concentration of stop-loss orders, as well as the potential buy-stop orders from long retail traders who operate on breakouts. Sell-side liquidity, conversely, refers to areas in the chart where there is a concentration of stop-loss orders, as well as the potential sell-stop orders from short retail traders who operate on breakouts. Next, we'll examine how the market responds when it encounters these liquidity zones. Suppose the price is moving towards equal highs, and retail traders start selling as it nears the resistance, placing their stop losses above it. If the price pushes upward and breaks through the resistance, it triggers the stop losses of those who entered short positions, generating significant buying pressure as these short positions are covered. Additionally, it activates the buy stops of traders entering long positions post-breakout. This combined buying pressure leads to a surge and creates inefficiencies at the top of the structure, potentially encouraging more traders to open long positions in response to the increased market momentum. These scenarios can occur in both accumulation and distribution phases. The only difference is the primary direction the market will follow. Traders should be attentive to these zones to position their orders and stops most effectively, ensuring they can capitalize on the market's movements, whether it proceeds upward or downward. Understanding liquidity gives us clarity about where price is likely to move. But clarity alone is not enough. To trade consistently, we also need structure, context, and timing. This means knowing how to read the chart in a systematic way, across multiple time frames, so liquidity is not just identified, but used with precision. That is exactly what we're going to do next. Before we begin the chart breakdown, I want to explain how I read the market and organize information on my charts. I always use a top-down approach, starting from higher time frames to define direction and context, and then working down to lower time frames for execution. In this Euro-Dollar masterclass, we will first analyze the weekly structure to understand the dominant direction of the market. Then we will move into the daily chart to identify the key areas that are likely to shape the next reaction. After that, we will drill down to the 60-minute chart to time our execution with precision, always aligned with liquidity and structural flow. Inside this study, we will also build two practical entry models. The first is a daily-based entry that reacts to the 50% level of the fair value gap and focuses on favorable risk to reward conditions. The second is a 60-minute entry that waits for a confirmed change of character before positioning, providing a tactical option for intraday alignment. By the end of this video, you will have a complete multi-timeframe blueprint and two entry methods you can apply with confidence. Now we're going to start looking at the charts, and the pair we're analyzing in this study is the euro-dollar. Before we begin, keep in mind that every number I mention, such as weekly higher high number 4 or weekly higher low number 3, is simply a reference point to help you visualize the chart more easily. These numbers do not carry any meaning beyond guiding you through the structure shown on the screen. As we move into the weekly chart, we start to see the broader structure that shapes everything happening on the lower time frames. The story begins at the weekly low number 1, the moment when the market finally stops falling and creates the first potential shift in direction. From there, price expands upward and delivers the weekly change of character number 1, confirming that buyers have stepped in and taken control by breaking the previous weekly structure. After that, the market continues pushing higher into the weekly high number 2, establishing the first major peak of this new bullish cycle. Next, the market retraces and forms the weekly higher low number 3, a clean pullback that keeps the weekly trend intact and shows that demand is still active. From this point, price begins a new bullish leg that drives the market into the weekly higher high number 4, leaving behind the weekly break of structure number 2 and reinforcing the continuation of the trend. If you want to strengthen your ability to read this type of market structure, I recommend watching the video from our Smart Money course called the Ultimate Market Structure Masterclass, available in the description. At the top of this push, we have the weekly higher high number 4, together with the weekly possible break of structure number 4, which signals a possible structural shift, but still requires confirmation. The chart also highlights the weekly order block number 3, the zone that originated the main bullish displacement, and remains an important reference point for deeper retracements. In this specific movement, which is the leg from the weekly higher low, number 3, up to the weekly higher high, number 4, price has already retraced beyond the 38.2% Fibonacci level, which, according to our ComLucro rules, is enough to classify the correction as valid. Price is now approaching the 50% retracement of this leg, moving closer to the discount zone where deeper reactions often occur, although it is still positioned above the weekly order block number 3. With that in mind, the most important movement for our analysis is exactly this leg between the weekly higher low number 3 and the weekly higher high number 4. Since this is where the current retracement, the Fibonacci levels, and the potential structural shift are all developing. Now on the daily chart, we begin our analysis at the daily higher low number 1, the point where the market confirms short-term strength and begins building the internal structure that supports the larger weekly trend. From this higher low, the market expands upward and delivers the daily break of structure number 2, which shows that buyers gained momentum inside the daily flow and pushed price above the previous short-term high. After this expansion, price continues climbing until it reaches the daily higher high number 3. This level becomes a key reference for the bullish leg that follows. Once price reacts from this high, the market begins to pull back, and during this movement, we mark the daily failed change of character number 2. This shift is considered failed because after the attempt to break below the previous structure, price does not produce a break of structure to confirm the reversal. For a change of character to be valid in our ComLucro rules, it must be followed by a break of structure. Since that confirmation never appears, the bearish attempt is invalid and the bullish structure remains intact. As the pullback continues, the market finds support at the daily higher low number 4, which forms the base for another upward movement. From here, price pushes again and reaches the daily higher high number 5. This daily higher high number 5 is the same point as the weekly higher high number 4, meaning both time frames align at this structural extreme. At this same level, we also find the weekly possible break of structure number 4 and the daily possible break of structure number 5, both signaling that a potential structural shift may occur if price confirms with continuation. During this phase, we also highlight the daily fair value gap number 4, an inefficiency left behind during the bullish displacement. If you want help identifying fair value gaps correctly on your own charts, I suggest watching the video FVG Explained, How the Best Traders Spot Precise Entries, which is linked in the description. Beneath this gap, we also mark the daily change of character number 4, the level where a confirmed shift in daily momentum would take place if price breaks and closes below it. Finally, we approach the daily order block number 4, the key daily demand zone that sits above the larger weekly order block number 3. This alignment between daily and weekly demand strengthens the narrative because price is pulling back into an area where the higher time frame already suggests discount conditions. As price approaches this zone, the daily structure prepares for the next decisive reaction, setting the stage for continuation or reversal inside the weekly context. At this point, we can clearly see how structure and liquidity align on the chart. But to fully understand why price reacts so precisely at these levels, we need to look deeper into how liquidity is actually created and used by large market participants. That understanding is what allows us to anticipate these reactions instead of reacting to them after they happen. Now, we're going to understand how central banks and large financial institutions operate can provide deeper insights. Every time a buy position is executed in the market, there must be someone on the other side willing to sell to fulfill the corresponding buy order, and vice versa. Imagine that central banks and large financial institutions are interested in purchasing a significant amount of an asset. To do this, they require a high volume of sell orders. This need arises because without enough sellers in the market, their buy orders can't be executed efficiently. To achieve this, these large players need to create a scenario where there are enough sell orders in the market. One way they do this is by triggering stop-loss orders that retail traders have placed just below support levels. By driving the price down to these stop levels, they can activate a large number of sell orders, creating the liquidity they need. This process involves causing enough market movement to trigger these stop losses, thus creating a pool of sell orders. Similarly, if these institutions need to execute large sell orders, they require a high volume of buy orders. They can trigger these by driving the price up to resistance levels where many retail traders have placed buy stop orders above the resistance. By pushing the price up to these levels, they can create a surge of buy orders, which provides the liquidity needed for their large sell orders. This involves creating a market scenario where the price action reaches the levels that trigger these buy stops. This manipulation creates an illusion among retail traders. They might think they understand the market movements, but in reality, the market is being driven to their stop-loss levels by these large players. After triggering these stops and creating the necessary liquidity, the market often resumes its original trend. So as you can see, understanding how central banks and large financial institutions operate can give you a significant advantage in predicting market movements and placing your orders more strategically. To understand this more clearly, let's consider the scenario where smart money aims to execute a large sell order. As the price moves upward towards the buy-side liquidity, it breaks through the resistance level. This action triggers the stop losses of retail traders who had open short positions near the resistance, causing them to execute buy orders to cover their losses. Simultaneously, it activates the buy stop orders of traders who were looking to buy as the price breaks through the resistance. This influx of buying orders creates a significant amount of liquidity in the market. With this significant influx of buy orders, smart money seizes the opportunity to execute their large sell orders. By doing so, they induce numerous buy orders into the market, which allows them to sell a large volume without causing a significant initial price drop. Once these sell orders are executed, the price enters the markdown phase, pushing downward. This scenario illustrates how smart money capitalizes on buy-side liquidity. They trigger buy stop orders and stop losses to generate the necessary liquidity for their large sell orders, then use this liquidity to move the market in their favor. A similar concept can be applied to sell-side liquidity, where smart money triggers sell stop orders and stop losses below support levels to generate liquidity for their large buy orders. With this in mind, the key takeaway is that smart money does not execute randomly. Liquidity is engineered first, and only then does price deliver the move. Once this process is understood on the higher time frames, the next step is learning how to align execution on the lower time frames, so entries are placed after liquidity has been taken, not before. Now we move to the 60-minute chart. And at this point, we will look for two different types of entries that align with both the daily narrative and the intraday structure. The first type of entry comes directly from the daily context. When price taps the 50% level of the daily fair value gap, we prepare a buy order targeting the order block on the 60-minute chart that created the last change of character to the downside. With a stop loss placed just below the daily fair value gap, the risk to reward becomes 1 to 4.80. If we choose a more conservative stop, placing it below the daily order block, the risk becomes higher and the reward becomes smaller, reducing the overall efficiency of the setup. The second type of entry is more aligned with the internal structure of the 60-minute time frame. Since price has already tapped the daily fair value gap, we will now wait for a confirmed change of character to the upside on the 60-minute chart as a condition to open a long position. Once this shift is validated, we enter the trade, placing the stop loss below the swing low that forms the change of character. The target, once again, is the 60-minute order block that caused the last bearish change of character, creating a risk to reward of 1 to 1.9, and offering a tactical intraday entry that respects the structure of this time frame. And as we finish this study, it's important to note that every entry model we outlined here reached its target with precision. Both the daily-based entry and the intraday 60-minute entry delivered clean reactions and completed their objectives, showing how structure, alignment, and clear execution rules can lead to consistent and profitable outcomes. So, to bring everything together into a single practical framework, we are now going to play a short clip taken from the full video linked in the card, titled, How Professional Traders Use Liquidity. 4 Advanced Trading Hacks. This clip will give you a clear preview of how these concepts are organized into a repeatable trading process. Let us begin. Hack number 1 is to define the trading range before doing any other analysis. The starting point is straightforward. Before looking at anything else, you must first determine the current trading range. So what exactly is a trading range? It is not simply a box or a period of consolidation. A trading range represents the area where price is actively moving and where liquidity is forming. In simple terms, this zone provides the clearest insight into where price is likely to move next once it breaks above or below it. And while price remains inside this range, close attention to price action is essential. So how do you properly identify the current trading range? The first step is to zoom out to at least 1 or 2 higher time frames compared to your execution time frame. For example, if you enter trades on the 1-minute chart, your range should be defined on the 15-minute chart. If you trade on the 5-minute chart, look to the 15-minute, 30-minute, or 1-hour charts. If your execution time frame is the 1 hour, then your trading range should be taken from the 4-hour or the daily chart. This is a crucial rule. Never define your trading range using the same time frame you use for entries. Please also remember that the mission of the ComLucro channel is simple. We focus on giving traders clarity, confidence, and structure, so market decisions are made with discipline and intention. On this channel, you will find complete courses built as a true trading masterclass. We teach market structure, higher time frame trading, and supply and demand, always focused on understanding price behavior and executing with a professional mindset. We also go deep into trading psychology, risk management, and consistency, because trading is not just about charts. It is about mindset, discipline, and structured execution over time. There are no shortcuts. Real progress comes from continuous learning and practice. Our main courses include Smart Money Concepts, Technical Analysis for Day Traders, Trading Psychology, and the Wyckoff Method course. Alongside our courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, and Larry Williams, whose experience has shaped how traders understand markets today. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are on the same journey. Make sure to subscribe and turn on notifications so you don't miss our latest lessons and insights. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? What topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro Trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.